Good morning and how do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you to today's session where we're going to take a long-neglected look at gold. We're going to take a deep dive into the precious metal to understand a phenomenon we have not seen in, well, I guess, close to 2 years. The double bottom. This is a 2-day chart. We see that gold has tested 1627 twice. 1630, 1629, 1627, twice in the last, we'll call it 2 months, and it failed to penetrate below that point, indicating a likely upturn. Now that's the technicals, and we're not generally so wedded to the technicals, but there are some very telling technical signs, and we're going to take a deep dive into them right now, and then we'll go into the fundamentals. If we expand our data set, and this in itself is a fairly large data set, but we have a lot of data here on gold. We notice a particularly unusual phenomena in the commitment of traders report. This is a little viewed but often occasionally important product by the Commodities Futures Trading Commission on all futures contracts traded in Chicago. And it segregates all positions by large speculators, small speculator, and commercial nets. Commercial are the commercial hedgers, and they're going to generally perform in the inverse to the market because they're hedging. The small speculators, the green line, are invariably wrong, so we don't pay any attention to them. And presumably the large speculators are what is commonly referred to as the smart money. But make no mistake, they're wrong plenty of the time too. But what I do want to point out is this phenomenon. We see this in 2015. We see this in also several times in 2015. We see it again in 2018. When these lines converge at the zero line, those have proven to be indicators of very, very high reversal in price. We are approaching such a point at this juncture now. I also want to point out that on the 2-day chart, the force index is in positive territory as well. I also point out that we're just, I'll make this larger now, we're just kissing the 20-day, the 40-day moving average. If we break this down into a 1-day chart, we can get a little more precision there. We're just kissing the 20-day moving average right there. And it's likely, in our opinion, and we are speculating and therefore could be wrong, and therefore let me emphasize that you should be only trading with money you can afford to lose, because we're speculators, we're not long-term investors, and therefore we liken our little job in trying to take money out of the market to picking up nickels in front of a steamroller. Stick around too long and you'll be crushed. So you have to be adroit and you have to be willing to stomach loss. Having said that, we think this is a rare buying opportunity for gold. And now we're going to go into the fundamentals. We see that fiat currencies are debasing worldwide. We see that inflation is rampant. We see that central banks are raising interest rates. And we're also of the opinion that they're going to start wimping out. Because as those increases in interest rates start to slow economies down and recession starts to bite, we think that they're going to reverse, and therefore inflation is going to really run. Once that happens, we anticipate this chart to reverse and approach its former highs of just around $2,000 a troy ounce. That's our position, ladies and gentlemen. It's an unusual and a longer-term position than we usually take. We think this is a good buying opportunity for gold, not a major speculative opportunity at the moment, but we recommend putting some money into gold at this point. We think it's going to be turning in the very near future. So, ladies and gentlemen, that'll do it for now. I'm your host, Seth Julian, wishing you all the ability to trade with confidence, ladies and gentlemen. Bye-bye for now.